are a lot of things that can throw off your retirement, but investments should not be one of them. Today, I'm specifically going to talk about 3 risks that you cannot ignore when it comes to your investments, especially in retirement or as you prepare for retirement. No, this is not going to be a video about some of the top investment ideas. I leave that to people much smarter than me. I specifically just want to talk about some retirement risks that you're going to see, going to be much more understandable, I hope, than talking about standard deviation, alpha, all those fancy words that pretty much mean nothing to anyone. So whenever your retirement is, today is going to be speaking specifically to you, the fair disclosure that anytime we talk about investments, it's important to understand that past performance is not indicative of future results, and you should always speak with your financial advisor about your investments, okay? Fair disclosure. Let's get into the list. 1, investment growth still matters in retirement. Yes, before you jump into a 60-40 portfolio just because it's a general rule of thumb, or just before you add in as many bonds or safe investments as you possibly can into your portfolio, keep in mind that sometimes we're seeing folks stay in retirement longer than they stay in their careers, right? If you think of someone retiring before the age of 60, even before the age of 65 when Medicare kicks in, there is a decent chance in today's world with medicine and technology that your career in retirement is going to be longer than your career at your job. So that's very important to understand the importance of having continued growth with your investments in retirement. So let me show you a chart here in a moment. We're going to assume someone retired in 2010, and we're going to see what the difference would mean in investing in a 60-40. I'll show you a 40-60, and I'll even show you an 80-20. But first, what do those numbers mean? All that really means is 80% stocks, 20% bonds, or 60% stocks, 40% bonds, right? That 60-40 is always the general rule of thumb that you're probably seeing online. So let me pull that chart up here. And as you can see, as you expect, the portfolio with the most amount of stocks or equity, as they call it, is going to have the higher returns since 2010, closer to 12%. All I'm using here is the S&P 500 and the bond aggregate data from 2010 to 2025. So if you retired in 2010 with $500,000 in an IRA, here's what your account would look like today with each split. Now, it's always important to remember that this is just what's happened in the past, so it doesn't necessarily mean what is going to happen in the future, but it is a good barometer to gauge by. So yes, I understand that your portfolio or your nest egg is really the only thing sometimes that it feels like standing between you and having to go back to work, or standing between you and having to find part-time work. And I'm really here just to say it can be just as risky or even more risky when we compare playing it aggressive versus being overly conservative with our investments. And we need to be mindful of what that looks like in our particular case, right? Everyone's gonna have their specific needs in retirement and how much they can actually stomach losing. Because I do have to mention that with these portfolios structured, the more stock, right, the more equities that you own, like the S&P 500 index or a similar index, you are going to see more swings in volatility, right? And I'll save that for number 3, and I'm going to show you a chart just on President Trump's tariffs alone and what volatility looks like later. But let's move on to number 2. So the second here is you, the retiree, or you, the retired couple, are now the paycheck, right? You've spent your entire career, whether you're a business owner or whether you're someone that's worked at an employer, you've been used to bi-weekly receiving a paycheck from that employer. And now all of a sudden that faucet turns off and it's all entirely on you to essentially pay yourself and then use those for your bills, such as your mortgage, for your car, for your groceries, for your gas, right? Anything that you need is going to directly come from all of that money that you've saved up. Even further, you have spent your entire career, I'm assuming if you've watched this video, denying yourself continually. You have not spent excessively, so you have enough money to retire. The really big question is just whether that money is going to keep you from having to go back to work and do things that you don't want to do, right? If it's going to allow you to do the things that you want in retirement. So one of the biggest problems with becoming your own paycheck, as we'll continue to call it here, is not so much that retirees run out of money on accident, is that a lot of times building up so much stress and so much anxiety, just being fearful of running out of money, actually leads retirees to spend far less than they actually could, right? They have much more that they will end up with at the time of their death, and I'll show you that in a moment as well, than they otherwise could have. Common questions like how much can I safely take out a year, What happens if the stock market is down this year? Do I take out less? Do I take out from a different bucket? What investment accounts do I draw down from first to be the most tax efficient? Now let me get into that example I showed you here. So let me kind of break this down for you in a simple way. Let's say that this couple has $1.5 million saved. We're going to expect a 7% annual return from this couple, and at the same time, they're going to be adding about $60,000 per year from Social Security. Now he's retiring, this couple's retiring at 62, and they're planning on spending $80,000 a year and adjusted for inflation, meaning that's going to go up. They're going to live to 88 and 94, right? They're good eaters, they're healthy people. So if I were to just ask you after I just read off that to you, it might sound like your situation. What do you expect that this person would finish at, right? If they have that 7% annual return, which is fairly conservative, but again, depending on your risk tolerance, that might even be better than you might do, so keep that in mind. But if your answer was $7 million, if they were to finish with $7 million, that's what we have here, right? And this is just a projection, but this is a common occurrence that I see as a financial advisor, that someone comes into the retirement and they're very frugal and they're very worried about spending, and then they get further on into retirement and their money keeps compounding over time, as it does once you have large accounts like those of 500,000, and they say, hey, why didn't I spend more at the earlier years of my retirement, right? And that's really the power of working so hard and denying yourself for so long. So keep that in mind if you are someone with an IRA, with a 401k, right? You do want to know the amount that you can spend without, yes, running out of money, but at the same time without having to stress about spending $1 on yourself on vacation or something similar. Third risk I want to bring up here is that volatility is going to feel significantly different in retirement. I receive a lot more phone calls from those who are retired whenever a couple months ago with President Trump's tariffs, a couple years ago with COVID, right? I receive a lot more phone calls from those who are retired than those who are not. And again, it goes back to the reason that their nest egg, right, the ones that's getting pelted by poor stock market returns, is the separation between them and having to go back to work. It's what allows them to live their dream retirement, right? And not to be cheesy, but it's a pretty big deal, obviously. If we take, for example, 2008, the market dropped nearly 50% in less than a year. So that's a very scary proposition for a lot of retirees. This is something that not only pushed a lot of folks in that day, they pushed their retirement back. Those who did retire wished that they would have pushed it back, right? And this is an extreme example. I mean, 2008 is probably a once-in-a-century event, hopefully speaking. But we do have to be mindful of these situations, and then very mindful that volatility, when your portfolio is going up and down as it does, is going to feel a lot more stressful in retirement. There is a fancy word that comes along with all of this, and that's sequence of return risk. And really all this means is that if you have a poor year and you sell from your investments early on in retirement, it completely affects negatively, obviously, the rest of your retirement, right? Ideally speaking, you would never sell in a down market. Warren Buffett's famous rules for investing is 1, don't lose money, and number 2, don't forget rule number 1, right? And that's all based off of not losing money. Well, you say, how in the world can you not lose money? The stock market goes down on a pretty normal basis, all things considered. And there is no magical answer, right? If I was smart enough to predict what was going to happen in the stock market, I wouldn't be sitting here making this YouTube video. What I can say is having a cash buffer, having cash set aside can really be a powerful instrument during times of market volatility. Again, let me rewind to 2008. The following 2 years after 2008 represented roughly 24%, and then the following year in 2010 represented about 13% that a lot of investors gained if they were investing still in the S&P 500. So no, it might not have brought them up to where they were at in the previous 2 years, but I can tell you those who sold out definitely felt the sting. Now, if this example investor we're talking about here had a bucket of cash on the sidelines, right? Even just a year's worth of living expenses, what this person could have done is dipped into that bucket when their portfolio was down 40%, let the market recover, as it traditionally has always done, and then waited to dive into that portfolio for their living expenses in retirement once the portfolio had sustained itself again. So that's just an example, and that's cherry picking history, but it is a very realistic scenario. We see even more so, as I mentioned just a moment ago, with President Trump's tariffs. And that brings me into a bonus segment here. Let's take a look at this year of performance with the S&P 500. You can see that this looks like a big, scary roller coaster at Six Flags. And the reason is, as I'm sure most of you know, is that President Trump has announced a lot of new plans for the United States since taking over as president for a second term. The main one was tariffs, and you can see significant decreases in March and April. Now, a lot of investors may or may not have pulled their money from the stock market in March and April only to miss the upswing. There's also a very common chart that's also used a lot, and it's basically missing out on the best days of the stock market can significantly impact your portfolio. While it's easy to say, right? It's easy to say just invest and walk away, or passive beats active. I understand that you are a human with an iPhone. I am a human with an iPhone, or whatever phone you have. We all watch the news, even if we don't, right? It's one of the evil powers the world has nowadays is we're gaining access to headlines without even looking for them. So if something's going on in the stock market and you're retired, odds are you're going to know about it. So it's more important to be realistic with yourself and understand that these stresses are going to come up in retirement more so than not. And so it helps to remember principles like this. And the evil thing of all this is nobody knows, and if they're out there, they haven't spoken with me, but nobody knows where the bottom is, right? Just as in that chart, no one knew that March or April represented the bottom of the stock market tumbling, just as right now the stock market is up again this year, and no one knows when we're going to hit the ceiling. Right? Again, if I knew that, I wouldn't be sitting here, and I don't think anyone's smart enough to know that. So that's just something to keep in mind. That's something to think about next time you hear a market prediction or a market theory, best stocks to invest in, right? It's all baloney if you ask me. So that is going to be it for today's video, folks. I hope this has been helpful for you. If you have any questions, please feel free to comment below. Feel free to comment any videos you'd like to see in the future, or I'd be happy to run a one-on-one meeting with you about your retirement plan, which you can all find in the details. So I will see you next time. I thank you for your viewership as always, and have a good day.